This is the story of the largest precious metals manipulation case in history, and why the viral $60 trap theory doesn't match the documented evidence. September 2020 brought JPMorgan Chase's $920 million settlement with federal authorities for manipulating silver, gold, and other precious metals markets across 8 years, and that settlement sent multiple traders to prison while the bank admitted wrongdoing. The question is whether this proven manipulation means JPMorgan is now trapped in a position where they must deliver massive amounts of silver at $60 per ounce. So we're going to separate the verified facts from the speculation. The 29th of September 2020 marked JPMorgan Chase's settlement with the Department of Justice, the Commodity Futures Trading Commission, and the Securities and Exchange Commission, and the total payment of $920,203,609 represented the largest spoofing penalty ever imposed. Federal authorities broke down the settlement into $436.4 million in criminal monetary penalties, $311.7 million paid directly to victims as restitution, and $172 million in criminal disgorgement. This wasn't some rogue trader operating in the shadows for a few months. 8 years of illegal activity ran from March 2008 through August 2016, and the misconduct spread across trading desks in New York, London, Hong Kong, and Singapore. JPMorgan traders placed what the CFTC described as hundreds of thousands of deceptive orders across multiple markets that included gold, silver, platinum, palladium, and even US Treasury futures. 4 traders faced criminal consequences that went beyond just paying fines. Greg Smith, who worked as an executive director and lead gold trader, received 2 years in prison after federal prosecutors called him the most prolific spoofer that the government has prosecuted to date. Michael Novak got 1 year and 1 day behind bars, which is notable because Novak was a managing director who ran the global precious metals desk and sat on the board of the London Bullion Market Association. John Edmonds and Christian Truns both pleaded guilty and cooperated with authorities, and their testimony revealed they learned to spoof from more senior traders with supervisory knowledge and consent. The mechanics of spoofing show exactly how the manipulation worked in practice. Traders would place a large sell order to create the illusion of selling pressure, which drove the price down while other market participants reacted to this fake supply. That's when the trader would quickly buy silver at the artificially lowered price, then cancel the sell order before it could execute. The entire manipulation could occur in milliseconds to minutes, and the CFTC found that JPMorgan traders did cause artificial prices through these tactics. Nobody disputes whether this happened because JPMorgan's settlement included an admission of wrongdoing. The traders went to prison, and the evidence was overwhelming. What gets complicated is the difference between this short-term tactical manipulation and the broader allegations that circulate in precious metals communities, where many believe JPMorgan has systematically suppressed silver prices for decades through massive short positions and is now trapped in a situation where they must deliver silver at $60 per ounce or face financial base catastrophe. So what about this $60 trap claim? Financial databases, regulatory filings, COMEX exchange rules, and precious metals market analysis contain no formal definition or documentation of the $60 trap, despite extensive searching. No regulatory filing connects $60 to any specific delivery threshold, margin requirement, or market mechanism that would trap JPMorgan or any other bank. The phrase appears to originate from YouTube content and precious metals blogs rather than established market mechanics, which raises questions about its validity. The concept seems to combine several related theories into one narrative that includes a price threshold where banks holding massive short positions face catastrophic losses they cannot cover, a point of no return where paper silver claims overwhelm available physical supply, or a trigger for short squeeze dynamics that would expose alleged manipulation. Here's the problem with the entire premise. Silver has never reached $60 per ounce, not even close to that level. January 1980 brought the all-time high at approximately $49 to $50 per ounce during the Hunt brothers' infamous attempt to corner the market. April 2011 saw the post-financial crisis peak at $47.94, and 2024 delivered a 12-year high of $34.72 on October 22 before the price retreated. Silver trades around $31.88 per ounce as of the 11th of December 2024, which means reaching $60 would require an 88% increase from current levels and would represent a new all-time nominal high. The 1,980 peak of roughly $50 equals approximately $125 to $150 in today's inflation-adjusted dollars, which suggests silver remains dramatically below its historical real value by that measure. But if the $60 trap isn't based on documented market mechanics and silver has never even approached that price, what positions does JPMorgan actually hold in the silver market? Official sources give us verified numbers we can rely on. JPMorgan serves as the custodian for the iShares Silver Trust, known by its ticker symbol SLV, and in this role they store and safeguard approximately 488.5 million troy ounces of silver on behalf of ETF shareholders. SEC filings and the SLV prospectus document this arrangement clearly, and what matters here is that JPMorgan doesn't own this silver because they're simply storing it for someone else. JPMorgan also operates a COMEX-approved depository holding approximately 210 million ounces of silver total, but roughly 103 million ounces of this represents custodial silver for SLV. Subtracting the custodial holdings leaves an estimated 107 million ounces as JPMorgan's own position, which represents approximately 49 to 50% of all COMEX silver inventory. That's a remarkably concentrated share of the exchange's physical silver, and it's where verified facts end and analyst speculation begins. Ted Butler, who was the most prominent voice in silver manipulation theory until his death in 2024, claimed JPMorgan accumulated 600 to 700 million ounces of physical silver while simultaneously holding short futures positions. His methodology relied on analyzing churn in SLV holdings, examining COMEX delivery patterns where JPMorgan appeared as the largest receiver, studying aggregate bank participation report data, and making assumptions about silver acquired during market sell-offs. Nobody has independently verified or confirmed these estimates through any regulatory filing. The CFTC's bank participation reports show aggregate bank positions but do not identify individual institutions by name, which means claims attributing specific contract counts to JPMorgan are analyst inferences rather than official data. Understanding whether JPMorgan could actually be trapped in a delivery situation requires knowing how COMEX silver delivery works in practice. Standard silver futures contracts represent 5,000 troy ounces, and settlement happens through physical delivery of 1,000-ounce bars meeting 0.999 fineness standards. COMEX warehouse data distinguishes between registered silver, which has an issued warrant making it fully available for futures delivery, and eligible silver, which meets specifications but has no warrant issued because the owner hasn't made it available for delivery. Late 2024 numbers show total COMEX inventory standing at over 300 million ounces. Registered silver, the amount immediately available for delivery, sits at over 73 million ounces after climbing from roughly 30 million ounces in mid-2023. LBMA inventory in London holds approximately 827 million ounces, sitting near an all-time low. Current open interest stands at approximately 160,000 contracts, representing 800 million ounces in notional value. Against 73 million ounces of registered silver, this creates a theoretical 1-to-1 paper-to-physical ratio for deliverable supply, but against total vault inventory of roughly 300 million ounces, the ratio falls to 2.7 to 1. Some manipulation theorists cite dramatically higher ratios ranging from 378 to 1 to 408 to 1 by including all derivatives globally, though mainstream analysts dispute these calculations entirely. We've got proven spoofing manipulation from 2008 to 2016, concentrated positions in the silver market, and paper-to-physical ratios that concern some analysts. What's the actual case that JPMorgan is suppressing silver prices through ongoing manipulation? Proponents argue banks hold concentrated short positions representing 50 to 60% of the entire COMEX market, which enables systematic price suppression. The 2020 settlement proves JPMorgan traders actively manipulated precious metals for nearly a decade, and statistical analysis allegedly shows unusual price patterns during New York trading hours. December 2008 CFTC data showed just two U.S. banks held 98.64% of all commercial net short positions, which represents an extreme concentration. Former CFTC Commissioner Bart Chilton publicly stated he believed devious efforts were moving silver prices, giving the theory some official credibility. The mechanism works like this. If enough investors demand physical delivery rather than rolling paper contracts, it would stress the delivery system, expose paper to physical imbalances, and force short covering at any price. February 2021 brought the Reddit-inspired silver squeeze, which briefly pushed prices from $25 to $30 before reversing. And that demonstrated limited success rather than the explosive move advocates predicted. Current supply fundamentals do support bullish views for silver regardless of manipulation theories. The Silver Institute reports 2024 marks the 5th consecutive year of structural silver deficit, and industrial demand hit record highs driven by photovoltaics, electric vehicles, electronics, and AI infrastructure. Global demand of 1.21 billion ounces against production of approximately 820 million ounces creates a projected deficit exceeding 200 million ounces annually. Skeptics offer strong counter-arguments that challenge the entire manipulation narrative. Banks operate as market makers and arbitrageurs rather than directional speculators, according to critics of the theory. Ross Norman from Metal Daily explained to Bloomberg, "There's always been this theory that bullion banks have a massive net short position in silver in the New York futures market. That's true, but it is because they also hold a corresponding long position in the London market. But one side of this trade is visible and the other is not." Keith Weiner from Monetary Metals analyzed 21 years of silver basis data across 109 contracts and found banks earn small spreads through carry trades, buying physical silver while selling futures, and earning the basis plus lease rate minus borrowing costs. If banks were naked shorts facing squeeze risk, the silver basis would spike as contracts approach expiry, but instead it consistently falls, which indicates long speculators rather than shorts must exit under pressure. Jeffrey Christian from CPM Group calls manipulation claims lies and misrepresentations that don't survive statistical scrutiny or simple logic, noting that banks' short positions are hedged rather than naked speculative bets. Skeptics also point to silver's price history as evidence against systematic suppression. The metal rose from approximately $5 in the early 2000s to $50 in 2011, delivering a tenfold increase over that period. If manipulation effectively suppressed prices, why didn't it prevent this massive rally? The cries of suppression appear selective because price declines become evidence of manipulation, while price increases receive no such attribution. Here's something that complicates the narrative in an unexpected way. JPMorgan's own commodity research is publicly bullish on silver right now. Recent reports from JPMorgan project silver reaching $36 per ounce in 2025 and potentially $56 to $58 per ounce by 2026, and they characterize precious metals as their only structural bullish call for 2 consecutive years. This directly contradicts the narrative that JPMorgan needs to suppress prices to protect short positions, because why would a bank allegedly trapped in massive short positions publish research predicting dramatic price increases that would destroy their position? Current silver prices as of December 2024 sit around $31.88 per ounce after hitting a 2024 high of $34.72 in October and a 2024 low of $22.07 in January. Silver gained roughly 21% year to date, though gold outperformed with a 32% gain through different timeframes. The evidence supports a nuanced picture rather than either extreme narrative about JPMorgan and silver. JPMorgan's 2020 settlement proves tactical spoofing manipulation occurred for 8 years, where traders placed fake orders to profit on individual trades and senior leadership tolerated it. That's documented fact backed by criminal convictions, not theory or speculation. What remains unproven is the broader claim of systematic, long-term price suppression through massive naked short positions. Multiple CFTC investigations found insufficient evidence to support that theory, and the agency conducted a separate 5-year investigation from 2008 to 2013 into systematic manipulation theories before closing it without charges, finding not a viable basis to bring an enforcement action. Mainstream analysts argue visible COMEX shorts are hedged by invisible London longs, and price history shows dramatic rallies that effective suppression should have prevented. The $60 trap concept lacks any verified basis in market mechanics, regulatory filings, or credible analysis, which is the core finding here. Silver has never reached $60, and no documented threshold exists at that level, requiring JPMorgan delivery or triggering margin calls. Spoofing convictions demonstrate banks' willingness to manipulate markets for profit, and concentrated short positions in silver are real and documented in aggregate data. Whether these positions represent manipulation or legitimate hedging remains disputed among analysts, while supply deficits and industrial demand growth provide fundamental support for silver. Extreme squeeze predictions have historically failed to materialize, which should give investors pause. The truth likely involves acknowledging that some manipulation occurred, backed by criminal convictions proving it, while recognizing that the more extreme theories, including the $60 trap, extrapolate far beyond available evidence. $920 million bought JPMorgan's way out of proven manipulation charges, but the claim they're trapped in an impossible delivery situation at $60 per ounce represents speculation without documented support. The silver market has real supply and demand fundamentals worth watching, and the manipulation convictions represent important history for understanding how these markets operate. Separating proven facts from unverified theories matters for anyone trying to understand what's actually happening in precious metals markets, and that separation is what this video attempted to provide.